Navitas Semiconductor is currently trading intraday at $25.39 per share, marking a solid upward push of 1.22% so far in today's June 9, 2026 session, with the stock oscillating between an early low of $23.96 and a high of $29.40 on active volume. While a casual glance at this performance suggests a standard tech bounce, the reality hiding behind this ticker represents a fascinating friction point between extreme speculative mania and hard-boiled fundamental physics. Just a few days ago at the Computex conference in Taipei, this small-cap power chip specialist saw its price skyrocket by roughly 19% in a single day, continuing an absolutely staggering run that has driven the stock up more than 300% since the start of the calendar year. The massive spike happened because the tech world's absolute kingmaker showcased a product that uses Navitas technology, immediately creating a frenzy among retail traders and institutional desks who are scrambling to find the next backdoor play into the artificial intelligence hardware boom. This massive structural move has triggered massive interest across major self-investing circles, where people using an online investment platform are looking to separate temporary hype from long-term sustainability. The common ground among most market participants right now is that Navitas is a golden ticket because it is directly plugged into the supply chain of massive tech firms like NVIDIA stock or Tesla stock, which require massive, efficient power infrastructure to keep their hardware running. The expectation is that because the absolute leader in artificial intelligence computing gave Navitas a visible nod, massive revenue pipelines are about to flow smoothly into the company's balance sheets. However, the cold reality underneath the surface introduces a massive point of tension that should make any disciplined analyst pause and re-examine the data. What was displayed at the conference was an ecosystem showcase, not a binding high-volume design win with guaranteed predictable cash flow commitments. Right now, this spectacular rally has pushed the market capitalization of Navitas near $6 billion, forcing the company to trade at an astronomical valuation of over 125 times its current sales. To put that into perspective for anyone looking at individual brokerage accounts or comparing risk profiles across top investing sites, a valuation like this means investors are paying a steeper premium relative to revenue than what private investors pay for elite, world-changing aerospace giants. The broader Wall Street community is flashing red alerts, with the consensus rating remaining at a cautious hold and the average analyst target price sitting under $14, which implies a potential downside of over 50% if the speculative fever breaks. This creates an intense psychological tug-of-war for anyone participating in online investing, whether you manage your capital through traditional firms like Fidelity Investments or utilize advanced tools on the Interactive Brokers trading desk. When you analyze recent stock movement, the sheer volatility of Navitas becomes the central story. The stock has been whipped around by massive daily swings, with institutional accumulation competing fiercely against aggressive short sellers and profit takers. The daily trading volumes have surged well past historic averages as the stock approached heavily overbought territory on the relative strength index, a classic sign that momentum chasers are piling into the name across everyday platforms like the Robinhood app. This behavior is highly typical of retail-driven frenzies, where fractional shares and rapid-fire active trading dominate the order flow. Yet savvy wealth managers look deeper at macro pressures. High oil costs and shifting bond yields have put heavy pressure on the broader Nasdaq and S&P 500 recently, but Navitas has completely decoupled from those macroeconomic crosscurrents due to pure artificial intelligence tailwinds. First quarter earnings for this year showed that their specialized infrastructure revenues grew 50% sequentially, proving that their deliberate operational pivot away from low-margin consumer electronics towards high-power data center applications is showing actual traction. But the question remains whether that growth can ever scale fast enough to catch up with a stock price that has moved like a vertical rocket line. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio, and let me know if you think this valuation makes any sense. To understand why the expectations are so incredibly high, we have to look closely at what this business actually does and how its core technology functions. Navitas is not a traditional chipmaker designing software or building massive graphic processors like Apple stock or other smartphone titans. Instead, they are an industry leader in next-generation power semiconductors, specifically focusing on gallium nitride, known as GaN, and silicon carbide, known as SiC. Traditional power management relies on legacy silicon, which hits a physical wall when forced to handle massive amounts of electrical current efficiently without generating destructive amounts of heat. GaN and SiC materials allow chips to switch at dramatically higher frequencies, handling high voltages while drastically reducing power loss and physical size. The specific product that set the market on fire last week was an 800-volt to 6-volt direct current power delivery board designed for advanced computing platforms. By completely eliminating intermediate power conversion stages inside server trays, this technology achieves a peak efficiency of 97.5% while operating at a switching frequency of 1 MHz. In simple terms, it allows hyperscale data centers to pack massive amounts of electricity directly next to hot, power-hungry processing clusters, cutting down on wasted energy and keeping the systems cool. Historically, Navitas started as a company deeply dependent on mobile phone fast chargers and basic consumer appliances. If you look back at older financial reports from prior years, their financial footprint was relatively modest, often tied to the highly cyclical consumer hardware market where margins are razor-thin and competition is brutal. The transition to high-power environments began picking up speed over the last 18 months, culminating in a series of strategic board appointments, including veteran executives from major hardware firms, to steer the ship towards enterprise markets. Their total addressable market for data center power architectures is projected to expand significantly by the end of this decade, with internal estimates suggesting a multi-billion-dollar opportunity as cloud providers move from standard power setups to megawatt-scale server racks. This long-term potential is exactly what long-term investors look for when customizing portfolios through an automated system like Schwab Intelligent Portfolios or setting up dedicated retirement accounts via Fidelity Iris. They see a company that owns critical intellectual property at a time when electricity availability is becoming the single biggest bottleneck for technological expansion globally. Looking forward, the future outlook for Navitas depends entirely on how the gap between today's speculative price and tomorrow's operational reality closes. There are two distinct paths this could take over the next 12 to 24 months. In the optimistic scenario, the high-profile endorsement from the world's leading chip designer acts as a massive marketing catalyst, forcing major cloud hyperscalers and server manufacturers to integrate Navitas hardware directly into their upcoming product lines, turning speculative interest into massive multi-year supply agreements. If sequential revenue growth continues at its current double-digit clip and margins expand as high-power sales dominate the mix, the company might eventually grow into its premium valuation, rewarding aggressive investors who bought the asset through automated robo-advisor tools or active trading apps like SoFi Invest. The alternative, more dangerous scenario is that the broader market undergoes a reality check. If actual orders materialize slower than expected, or if larger, well-capitalized legacy chip farms introduce competing silicon carbide or gallium nitride solutions that undercut Navitas on price and distribution, the speculative premium could evaporate overnight, leaving retail buyers holding the bag. When we synthesize the core dynamics of this asset, the central insight is that Navitas Semiconductor is operating in a territory where investor psychology has completely overtaken near-term financial metrics. The tension between expectation and reality is stretched to an absolute maximum. The expectation is that Navitas is an indispensable, friction-free gateway to the physical infrastructure powering the future of computation, a belief validated by recent high-profile technology showcases. The reality is that the company is currently priced for absolute perfection, trading at an extreme multiple that requires decades of unblemished hypergrowth execution just to break even on a fundamental basis. For anyone tracking this through advanced setups like the Interactive Brokers platform, or simply watching the daily charts on a smartphone screen, it serves as a masterclass in market narrative. The company's core technology is undeniably impressive, and its strategic shift towards enterprise data centers is proving to be a smart operational move, but the stock has transformed into a high-stakes casino chip for momentum traders. True clarity will only arrive in the coming quarters, when actual corporate earnings either substantiate this breathtaking multi-100% rally or force a violent correction back down to historical support lines. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Business Bell. Don't forget to like, comment, and share this video to support the channel. Heart.